Over 90% of people don't make money in crypto, not because they ape into garbage coins. Even FTT pulled a 3x during the election pump. The real reason is that most don't have an exit strategy. They get greedy, hold too long, and wait for another pump that never comes. I've made a few videos on exit strategies before, but this one's different. Earlier I focused on selling during euphoria. This time we're diving into a worst-case scenario exit plan. Jim asked a brilliant question on my last exit strategy video, and I'm going to unpack it here in detail. He asked, if trade wars are de-escalating, then why would the Fed still pivot? And what's my strategy if the top is already in? Quick shout out to everyone who drops comments regularly. Seriously appreciate you guys. I actually enjoy reading and replying to every single one. And hey, if these videos bring you any value, smash that like button. It really helps more than you think. Alright, let's get into it. In crypto's risk-on environment, having a good handle on macro is key for exits. Indicators that nailed the top last cycle might not work this time, so it's smart to keep one eye on the big picture and the other on sentiment indicators. Let's tackle the first part of Jim's question. If trade wars are cooling off, why would the Fed add liquidity? Tariffs were announced back in February. In January, I'd already said we won't see looser monetary policy until Q4 2025. These tariffs haven't changed much in the long run. Let's rewind. Trade wars mess with supply chains, jack up costs, and spike inflation. Markets hate that kind of uncertainty, so they tank, and people expect the Fed to jump in and print money. Now that tensions are cooling, markets are recovering. So less reason for Fed action, right? Not exactly. The Fed doesn't just react to trade tensions. It watches the whole economic landscape. Look at the data. Inflation is still sticky, staying above the Fed's 2% target. The dollar index is slipping, which hints at weaker global demand for dollars. Meanwhile, gold's hitting new highs, a classic red flag that the market's bracing for uncertainty or currency devaluation. Put together, this paints a picture where markets expect the Fed to ease up, either by cutting rates or printing money again. So yeah, even if trade wars are calming, inflation's still a problem and growth is fragile. The Fed's juggling inflation, employment, and overall financial stability. If they over-tighten, they risk a deeper slowdown. So the pivot might come not because of trade wars, but because the broader economy still needs support. Bottom line, trade wars fading removes one pressure point, but the Fed's eyeing bigger risks. With high rates, a falling dollar, and gold ripping, they may still pivot to stabilize things. Now let's talk worst-case exit strategy. Jim rightly pointed out that my previous strategy assumes the bull market isn't over yet, which is true. I have specific invalidation points that guide my decisions. As long as those aren't triggered, I stay bullish. So first, let's break down what those invalidation signals are. To figure out when Bitcoin's bull run might be done, I track 4 key indicators. These are so crucial that even one flashing red could make me exit. 3 of them detect signs of a bullish top. The 4th warns of a bearish breakdown. These indicators worked great in 2017 and 2021, flagging peak cycle moments. The first one is the Pi cycle top indicator. This indicator is quite reliable. It signals market tops when the 111-day moving average crosses above the 350-day moving average. It nailed the $19,500 peak in December 2017 and flagged the $60,000 level in November 2021, not far from the actual $69K top. In previous cycles, this crossover has been a solid sign of a market top. What makes it so valuable is its consistency across previous bull runs. If this crossover happens again, I'll seriously consider the bull run done. It's one of the earliest indicators to start flashing red when we're nearing the peak. The second tool is the MVRV Z-score. It compares Bitcoin's market cap to the value of all coins at their last moved price, normalized as a Z-score. Essentially, it gives us a sense of how overvalued Bitcoin is at a given point. A score above 7 signals extreme greed and irrational exuberance. It hit a score of 9 in 2017 and 7 in 2021. However, this cycle, the highest we've seen is around 3.3, far from euphoric, so we're not there yet. This is critical because it shows how much room the market still has to go before entering the mania phase. If it crosses above 6 and we get a price rejection at the highs, that's a major red flag. It's a great mania detector, but it can stay high during parabolic moves, so I always double-check with sentiment tools like the Fear and Greed Index. The Fear and Greed Index can act as a complementary tool here, helping to confirm whether the market is nearing peak euphoria or still in more rational territory. I'll link all these indicators in the description below so you can keep track of them yourself. These tools are incredibly helpful if you want to avoid getting caught in the hype. Third up is the Altcoin Index Indicator. This one zooms out and looks at how altcoins are performing relative to Bitcoin. It measures the altcoin market strength compared to Bitcoin, which gives us a clearer picture of where the overall market sentiment is. When this index jumps above 90, that's usually the sign of peak hype. In both 2017 and 2021, we spent about 3 months above 90. This is when we typically see altcoins outperforming Bitcoin by huge margins, signaling an overheated market. That's when you want to be unloading your altcoin bags. In December 2024, it spiked to 87, the highest it had been since the last bull run. That was a clear warning sign. I sold a few alts then, and that played out well. But here's the kicker, it wasn't the top yet. I'm expecting that 90+ range to last for a couple of months during the true euphoria, which is when we'll see the most insane altcoin rallies. The point to take from this is that the true euphoric top might not happen instantly. It might build up with increasing dominance in altcoins before we see the final blow-off top. These three indicators work together as a toolkit for identifying market cycles. When you start seeing all of them lining up, it's a strong signal that the market might be reaching its peak. But of course, no single indicator should be trusted in isolation. Combining them gives you a better understanding of where we stand in the market cycle and helps you avoid the risk of getting caught up in a parabolic move that might end in a sharp correction. Now, what if none of those three indicators flash and Bitcoin just slowly starts sliding its way down to Goblin Town? That's where my bearish signal comes in, the 50-week simple moving average. It's my guardrail for identifying breakdowns or breakouts in a bear market. I rotated my 2021 gains into Bitcoin at $25K when it broke above this line. So when do I flip bearish? Simple. If Bitcoin breaks and closes below the 50-week SMA, I'm selling. We recently dipped below it but recovered quickly. Right now, it's around 78K. It's not fast, but it confirms major trend shifts. So if any of the three bullish top indicators flash, or we break below the 50-week SMA, I'm out. That's my line in the sand. Apart from this, I would also watch funding rates and open interest. If prices are falling but funding stays positive, it means longs are still hopeful, a bad sign. That's when I'd rotate harder into stablecoins or hedge using perps. Also, I track dominance and stablecoin inflows. A sudden spike in Bitcoin dominance with falling prices means people fleeing alts. Same if stablecoins start pouring into exchanges without big buys, that's often exit liquidity being prepared, not fresh money. Fourth, I'd shift my mental model from profit maximization to capital preservation. I'd stop trying to time another euphoric push and focus on staying liquid and mobile, to either re-enter lower or take advantage of the next macro setup. And lastly, I'd remind myself, sitting in stables and doing nothing is also a trade, sometimes it's the best one. Let's say the top is already in. What then? By the time those first three indicators flash, I'll already be 30–40% out. That's because I've got exit plans locked in for individual alts, which I covered in my earlier exit strategy video. I will drop the link at the end of this one. At that point, I'm selling everything, even Bitcoin, except for a small moonbag of alts, just in case we get one last surprise pump. Right now, Bitcoin makes up about 25% of my portfolio. It's mostly profits rotated from altcoins. And yeah, I'm willing to sell that BTC stack above 150K. Now, if Bitcoin breaks below the 50-week SMA, I'll clear out all remaining alt positions. But I'll still hold onto my 25% BTC stack. Selling Bitcoin below 78K just doesn't make sense to me. And apart from that, I've got a separate long-term BTC bag that I'm not touching anytime soon. Now that we've had a decent relief rally, if you were overexposed to alts and sweating during the dip, it's probably a good idea to trim a bit. Let this be a reminder, you need a plan before you enter any trade. Know your entry zones, your profit targets, and your invalidation levels. A clear plan keeps you rational when the market gets emotional. Even experienced investors get caught in fear and greed. I've got 2 positions I'm still stuck in because I got complacent. They're small, but I keep them as a reminder of what happens when you drop the ball and to never lose discipline again. A systematic approach to profit-taking helps you avoid impulsive moves. Selling everything at the all-time high is a myth. That's why you sell in layers so you don't round-trip your gains. Hope this video gave you some clarity and helps you join the 10% who actually lock in profits this cycle. If it did, smash the like button and share it around. We also drop gems on X and in the community Discord, links are in the description. I'll catch you in the next one.